Rio Tinto is down 14% year to date with a yield of just under 6%. But is this company severely valued, undervalued in fact? And can we expect to see some incredible growth over the next few years, locking in a very nice yield with our yield on cost growing into double digits? In today's episode, we're going to look at the historical performance of Rio Tinto. We're going to jump into their income statement, look how their top line growth has performed, as well as that bottom line net income. We're going to take a look at the health check of the company, their balance sheet, their total cash versus total debt movement. We're going to take a look at some of their competitors, how they've performed year-to-date total return, as well as the last 5 years to see whether or not it is outperforming its competitors. And we're going to take a quick look at institutions, whether they are buying or selling the company over the last few quarters. And this will tie nicely into that all-important dividend safety and some financial metrics you need to understand before investing in this company. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given that margin of safety. Now, year to date, it is down 14%, and as we can see, it is towards the mid to lower end of the 52-week range. Now, investors who have been holding the company over the last 10 years would have seen around a 30% share price appreciation, which in all honesty for a 10-year investment is very poor, even when you include those dividends reinvested. Now, a forward yield of 8, which we will compare to the 5-year average, but as we can see, the whole point is to understand is this currently a cheap price, and can we expect to see not just share price appreciation, but our yield on cost grow into the double digits? Now, in terms of the company itself, how has it performed year on year? Well, what do we like to see on that top line? Personally, 3 to 7% growth year on year. December 2018, around 40.5 billion on the top line. December 22, their latest annual report, 55.5 billion. So some very nice growth over the last 5 years. But on a more granular level, what do we see? We see an increase from 2018 to 2020, although very marginally. And then we see a very large increase to 2021 before a decrease to 2022. So some slight inconsistencies with the growth. It's not growth year on year. And how does the bottom line compare the all-important net income? Well, 13.6 billion in 2018. 5 years later, in fact, with more revenue, they have had less on that bottom line, 12.4 billion reported. So interestingly, whilst revenue's gone up over the last 5 years, the bottom line has gone down. And what we can see, 2018 to 2019, a decrease in the net income before an increase, and then an astronomical increase in 2021 before decreasing. So both top line and bottom line are essentially very, very inconsistent. And in terms of the balance sheet, a quick health check, let's look at the cash versus total debt. Well, total cash and short-term investments in 2018 sitting around 13.5 billion. Latest quarterly report showing around 10.5 billion. So what we can see is they are holding less cash over the last 5 years. And how does that compare to their total debt? Well, essentially what we can see when we take a look here at their total debt, 12.7 billion. And in their latest quarterly report 5 years later, 14 billion. So whilst their cash is decreasing slightly, their total debt is also increasing again, but very slightly. And we'll take a look at how this fares for essentially that all-important dividend safety score. Now, let's do a comparison of the total year-to-date return of Rio versus some of its competitors, such as Glencore, BHP, Anglo American, and a few others. So year-to-date, what we can see, as we mentioned, Rio is down around 6.73%. Do bear in mind that includes those dividends reinvested. It's essentially the middle performer of its competitors, with essentially the best performer being TECK. Now, over the last 5 years, how does that essentially compare Rio versus their competitors? So what we can see when we scroll down, and this essentially does like to load up, we can essentially see that Rio has had a decent performance of 104% over the last 5 years. Yes, it's not the highest performer out of its competitors, but in actual fact, it is the second, with the highest being IVPAF at 274%. So if we're looking at Rio in isolation, 104% return is fairly decent for any investment over the last 5 years. Now, in terms of institutions, what are they doing? Well, straight away, institutions own around 10%, which isn't typically that much of an ownership of a company. A few that we have analyzed before have around 70 to 80%. So personally speaking, not many institutions do hold a position in Rio Tinto. Now, in terms of are they buying or selling, interestingly though, what we can see over the last 12 months, there's been an inflow of 1.94 billion of shares bought and also 1.94 billion shares sold. So we can see there has been a mix, with Q1 of 2023 around 1 billion sold with only 500,000 bought, and in Q2 roughly the same amount bought as sold. So we can see some mixed essentially information there, but it really is just purely showing us about what we can see in relation to the institutions. Now, in terms of the dividend safety, straight away a score of 40, making it unsafe, and we'll delve into that deeper. Market cap 103 billion, making it a mega cap company. Now, in terms of the recession, if you believe we are heading into one, the last recession, how did they perform? Well, in actual fact, they cut the dividend in 07-09. Recession sales, negative 25.8%. And even with the S&P 500 having negative growth, this was a lot larger of a negative growth in that period span. Also, in terms of the return, negative 71% versus the S&P 500, negative 55%. So straight away, if you believe a recession is happening, whilst prior year data is not there to essentially forecast the future, it is showing a very, very bad sign for Rio. They also recently cut their dividend, as I'm sure you're aware, around 37%. So therefore, their dividend growth streak is 0 years. However, prior to that, they had 11% dividend compounded annual growth over 5 years and 11% again over 20 years. Just one thing to note, which I haven't mentioned already, but regular viewers will know, you want 4% increase in dividends, salary, other income producing assets. The reason for this, the US inflation rate was 44% over the last 40 years. Anything less, you are taking a pay cut and losing your purchasing power. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. And what we can see now, 6.54 versus 6.54, essentially showing us reasonable valuation. But as always, we do not look at any model in isolation and will draw conclusions towards the end of the episode. Likewise, forward PE roughly in line with the 5-year average of 8 versus 8.4. And we can see the sector PE significantly higher at 16.3 versus 8. As I mentioned at the beginning of the episode, it is trading towards the lower end of that 52-week price range, but 52-week low doesn't necessarily mean undervalued. Likewise, 52-week high does not mean overvaluation. Now, what essentially do we look at? Personally, what I like to look at is the free cash flow over the earnings. The reason for this, earnings is susceptible to manipulation by management through accounting. Data is available though if you essentially want to use that metric. Personally, free cash flow below 60% is what I like to see. The reason for this, I believe 60% means management have that ability to grow those double-digit dividends we love to see. Now, for a mining company, what we can see, Rio Tinto, it has not really been consistently below 60%. In fact, quite a number of years in the 80s and some years in the 70s. Now, 2022, 85% is a little too high for my liking, but 2023 is also expected to be in the 80s at 84%. So do bear that in mind. They are paying out a significant amount of free cash flow generated as dividends. Earnings per share, again, the information is there for investors that like to use that metrics, but I prefer to focus on the free cash flow. $1.12 in 2013, $5.79 in 2022, essentially more than 4 times growth over the last 10 years. Going in the right direction as well, but you can see the inconsistencies where some years they do drop. You could argue it's the cyclicality nature of the company. And no, in 2023, it is expected to be 473, lower than last year at 579. Now, sales growth, again, here we can see the real cyclicality of the business. Whilst we look for 3 to 7% growth year on year, we see some years of double-digit negative growth followed by double-digit positive growth. So again, do understand what you are investing in. And we can see in terms of sales, we can see top line growth, 51 billion in 2013, 55 billion in 2022. So around 10% growth over the last 10 years. But within that period, we see a lot of negative growth. Now, in terms of shares outstanding, yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. We can see they sometimes do small amounts of share buybacks, nothing too huge to really report on there. And then focusing on the ROIC, return on invested capital, one of my favorite metrics. What do I love to see? 10% plus, as it means management are able to effectively allocate their capital. And on top of that, it is one of my 7 golden dividend metrics. So if you want to see the other 6, do check the pinned YouTube video. Well above 10% nearly consistently every year. Essentially 25% in 2020, 40 in 2021, and 26 in 2022. So it gives me faith in management, and it's a very, very strong metric for the company. Operating margin and free cash flow margin consistently above that 12% that we like to see year on year, as well as that 5% on the free cash flow margin. So they are performing some very strong metrics here in relation to the business and the efficiency. Remember, the higher the operating margin, the higher that bottom line net income will be, which means higher dividends and higher dividend growths. Now, in terms of the net debt to earnings before interest, tax, depreciation, and amortization, whilst we reviewed the balance sheet, it wasn't something I flagged due to the fact that the total debt hadn't really moved at all, neither had the cash. Below 1.5 is what we look for, which signals the number of years it would take the company to pay off all their debt net of cash on hand. What we can see though, for the large part, in fact, every single year is below that. 2022 at 0.28, 2023 expected to be roughly in line at 0.32. So no real worries from what I can see about that dividend safety so far. And then when we take a look on the right, purely showing us the percentage of a company's financing from debt as opposed to equity. As always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe and bell button to join this lovely community. And if you want to grab a copy of the model to run your own intrinsic value of companies in your portfolio and get your own acceptable buy price, do click on the pinned comment below. Now, jumping straight into the first Met valuation model, we have the Graham's valuation, we have the stock ticker Rio, earnings per share, growth rate per analyst estimates, as well as that very high current yield on AAA corporate bonds, giving an intrinsic value for Rio Tinto at $59. Now, when we take a look at the current trading price, it's roughly there a few dollars off that, showing reasonable valuation and within that 52-week range. As always, though, we never look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. We then have the multiples valuation model, companies in a similar sector and size. We have BHP, Vale, and Tech, some of these companies which we reviewed in comparison to the total returns for the last 5 years. We have their stock price, EPS, and P multiples, average multiplied by the earnings per share to give a stock price of Rio at $48. Again, we can see here this is above that price, so it does show signs of some under or essentially overvaluation by the market and slightly lower than that 52-week low. We then move on to essentially the dividend discount model, the yearly dividends over the last few years, and as we can see, they did have that dividend cut. Now, including that, the dividend average growth is 10%. Forward looking, I have gone quite low at 2%. You could argue you believe it to be higher or even lower if you want to be more conservative. As always, do grab a copy of the model in the comments below to run your own figures through. However, based on my estimates and judgments, it's giving a DDM price of $76.50, showing some nice upside to the current trading price and slightly lower than that 52-week high. We then move on to the fourth and final model, the DCF model, discounted cash flows, where we have our free cash flows year on year. Average growth rate 37%, with analysts estimating a relatively flat forward-looking growth. Discount rate at 8%, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt and arrive at the equity value. Divide that by the shares outstanding to get a DCF price of $89. As we can see, above the 52-week high and above the current trading price, showing some strong signs of undervaluation in the current market. As always, if you have enjoyed the content today, smash that like button, hit the subscribe button and bell button to join the community and have these videos delivered to you on the daily basis. Now, the intrinsic value, as mentioned, is the average, coming at $68. Now, when we compare that to the current price at $61, it's not too far off. Now, margin of safety, I would say 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. Essentially saying that the current trading price is giving you a margin of safety of 10%. Now, personally, I would recommend a higher margin of safety, as I don't believe Rio Tinto essentially meets the criteria. So if you're looking for a 15% margin of safety, your acceptable buy would be around $58. As we can see, still within the 52-week range. If you believe you would require a 20% margin of safety at $54, and again within the 52-week range. And if you wanted a 25% margin of safety, you'd be looking around $51, which is slightly lower than that 52-week low not seen too long ago. Now, Wall Street, they are forecasting over the next 12 months for the price to go up to $81, so they see some significant price increases of what the current market is offering. But as always, let me know your thoughts in the comments below. Are you looking to buy Rio, looking to sell, or purely on the sidelines speculating? As always, do like if you enjoyed the video, value is being provided. It really helps the channel. Subscribe if you haven't already. And if you want to grab a copy of the valuation model to run your own company through to get your own intrinsic value and acceptable buy price, do click in the pinned comment below. As always, have a great day. Catch you on the next episode and take care.